In this week's video, we'll review the latest charts to help us answer the question, how many bearish boxes have been checked in the stock market? We'll be moving quickly, so feel free to use the pause button on your video player. The text on your screen comes from CNBC, and it tells us that virus data in the U.S. could continue to be troubling for a few more weeks, but based on what's happening overseas, it's also possible that we're just looking at a few weeks before we see some improvement. Just something to keep in mind when we're reviewing the charts in the remainder of the video. NASDAQ 100 advanced decline line chart dated Thursday, July 29th, left-hand corner of your screen. Bottom line here, this really doesn't look that bad relative to this period here, and this period here, where bad things happened in the triple Qs. Similar situation here. We'll be covering charts that tell us the market does still look somewhat vulnerable, but we really don't have the evidence in hand yet that says things are particularly alarming. This is NYSE, common stock only, new lows. You can see during the coronavirus plunge here where my cursor is in 2020, new lows expanded at an alarming rate. Something similar happened here in 2011 when we had a correction in the S&P 500 index. You can see new lows here started to expand well before bad things started to happen in the stock market here in 2015 into early February of 2016. This chart may get worse, but it doesn't really look too bad as of the close on Thursday. And during the video, we'll also take into consideration all of the data from Friday's session, because 100% of the video is being recorded after the close on Friday, July 30th. Everything that we said about the prior chart applies to this chart. This is somewhat of your alarming look, somewhat of an alarming look. Alarming levels here. After that, bad things continued to happen in the S&P 500. We're just not there yet in 2021. Keeping in mind, as we always say, a look like this can morph into a look like this very, very quickly. Covered these charts many times before, so we will move very, very quickly. This is the look we want to avoid, the look that we want to avoid. This is the look of the same indicator after the close on Thursday. And even during Friday's session at 10:22 a.m. Eastern Time, rather than rolling over where bad things happened in the stock market, we made a new high for the current rally intraday. Also noteworthy, if we zoom in on this level here and place it down here where my cursor is, bias has been to the upside. You can make an argument here this is somewhat of the psychology associated with an inverse head and shoulders pattern. NASDAQ 100 stocks greater than their 50-day simple moving average. You can see when the indicator gets here, where the red box is, bad things happen in the stock market. Here's the indicator here, then bad things happen. Get into this level here, malaise in the stock market. Get here, bad things happen. We're still way up here as of Thursday's close, and based on the breadth data that we saw during Friday's session, not likely that we're going to end up down here over the weekend. NASDAQ 100 stocks greater than their 150-day simple moving average. The NASDAQ is shown at the bottom for reference purposes. Just not that bad. In fact, here's a low made in March of this year in the indicator. This is a higher low. The recent low has been even higher than that. So you can make an argument that while it's getting worse up here, recently, in recent weeks, it's been getting better. Just not a lot of deterioration that we can see, measure, and put in a model just yet. This indicator looks at data from the entire American Stock Exchange, the entire NASDAQ, and the NYSE. We're looking at new highs minus new lows going back 5 trading days. As of Thursday's close, in recent sessions, this has been improving and trying to make a stand in an area where it's made a stand in the past and where the stock market made a stand in the past. If we move into this area here, we'll learn something as we did here during the early stages of the COVID plunge. S&P 500 stocks greater than their 50-day moving average. Here's a low, here's a higher low. Here's a period of consolidation lasting several weeks where my cursor's moving around over here. And on Thursday, we broke out to a new high above this consolidation box. Remember from past videos, the blue and orange lines indicate levels that were exceeded from a bearish perspective when things started to get a little bit more dicey in the 2010 correction and the 2004 correction in the S&P 500. As of Thursday's close on the 29th, we were above all four lines. That's the good news. The bad news is this is weaker and has been trending weaker, but the common theme here is we're watching it closely. It just doesn't look that bad yet based on the chart in front of us. Very, very similar situation here. You can pause your video player. This would be a level that was concerning before the correction, early stages 2004. This would be a level that was concerning 2010, where my cursor is. This is where we were as of the close on Thursday, well above that level. Model uses a weight of the evidence approach, thus we're looking at multiple indicators. This is just a handful of the indicators that we follow. S&P 100, this would be large, super large cap. S&P 100 greater than their 150-day simple moving average. Similar theme above both blue and both orange lines. And yes, many of these charts are as of the close on Thursday, July 29th, because these charts don't settle out until the evening. However, given this was the look of the breath data on the NYSE and the NASDAQ as of 2:37 p.m. Eastern Time on Friday, it's not likely that these charts plunged in a manner like this, something that we would be concerned about. In fact, by the end of the day here, up-down volume about 15 minutes before the close on the NASDAQ was slightly favoring advancing issues. New highs, new lows here still look relatively healthy. They've been bouncing back and forth between a decent look and concerning looks. We've covered this chart in the past. This is the equal weight S&P 500 RSP relative to SPY in the ETF world. This is the period here in September of last year, point A, where equal weight started to outperform up here to point B in May or early June of this year, and then equal weight started to underperform. It's come back to roughly the 38.2% retracement, trying to make a stand. However, it is a little concerning that it's below the June high of last year. As we've said in videos in the past, when RSP is outperforming SPY here, that's relative performance. This line or this ratio can be rising when both RSP and SPY are falling. It's just something to keep in mind. For example, when this period of outperformance started here, you can see that's in early September, late August of last year. If we move over to a chart that shows performance, this is where RSP in red started to outperform SPY in blue. However, it looks like good things are happening here, but as you walk forward, both RSP and SPY had significant drawdowns between early September of last year and roughly the third week of September last year. Here are the figures. Then we had a rally, and then this is the drawdown here and here from point A here, which is this point A here. Thus, even if RSP is trying to make a turn here, have to keep in mind it's within the realm of possibility that even if it makes a successful turn like this, which it hasn't done yet, that can happen in a situation where there is some pain or drawdowns in the stock market. You can pause your video player here. This is a wider range of ETFs here between September 1st of last year and September 23rd. Some fairly significant drawdowns, just helping us keep an open mind about a wide range of outcomes, and reminding us that even if RSP can make a turn, that doesn't necessarily mean in the short run that the markets will take off like a rocket. This is where the markets started to take off like a rocket in early November of last year, walking forward. In terms of bearish boxes, one thing we do know: if breadth data starts to deteriorate rapidly in a manner that could cause something like this over here or this over here during the COVID plunge, that would increase our concerns. Taken in isolation, that's just one piece of the weight of the evidence. We didn't really even have that on Friday. And remember, we said this point A here was early September of last year. Thus, what else might we look for before we had an 8% drawdown in SPY and a 6% drawdown in RSP? Well, volume expansion would be one thing to look for. You can see here, August 31st, the triple Q's 36 million. September 1st, things are fine, 36 million. September 2nd, still not bad. You can see ETFs were gaining between September 1st and September 2nd right here, 50 million. Then things start to go sideways on September 3rd. Volume goes from 36 million, 50 million to 110 million, 123, 99, 64, 69, and 71. That's a significant increase in volume, and it tells us that institutions may be lightening up. We just haven't seen something like that yet either, but it's something that we can monitor as part of the weight of the evidence relative to bearish probabilities. As a point of reference, after the close on Friday, July 30th, Yahoo Finance was showing the QQQ during the down day on Friday traded less than 33 million shares. Quite a bit lower than 110, 123, 99, 64, 69, or 71. What else might be a red flag or a bearish probability box that we might watch out for in the early stages of a move like this? Not only did we get very, very high volume here in early September, on September 3rd, the S&P 500 dropped 3.51% in one session. The NASDAQ dropped almost 5%, 4.96%. The Dow, 2.78%. S&P 500 equal weight, the index, 2.42%. Compare that to Friday's session, where the Dow was down 0.42%, the S&P 500 was down 0.54%, the NASDAQ even less than 1%, down 0.71%. And for now, the VIX still remains below 20. You can pause your video player and look at this chart in a little bit more detail. This is the Dow Jones Industrial Average, or the Dow relative to the NASDAQ Composite. It's a daily chart. This is the 200-day moving average in red where my cursor is. You can see we had a rally February of this year from point A to point B. The rally took us above the 200-day moving average, but since then, we're back below the 200-day. In fact, during Friday's session, we were below the 61.8% retracement, the 50%, and hanging around right around the 38.2%. So you can make an argument that this is somewhat of a normal pullback here. The problem, though, is at this point, we're coming out of a downtrend against the Dow and for the NASDAQ. Now this looks somewhat like a failed bullish attempt at a reversal. You can give the Dow a little bit of the benefit of the doubt in this area here, but that's hard to do here, and it's back into prove it to me mode. If you're a Dow bull relative to the NASDAQ, obviously you would prefer to see price get back above the 200-day moving average. It's below it right now. You'd like to see the 200-day moving average turn up in a bullish manner. Right now, it's trending down. And you'd like to see price get back above the 38.2, 50, and 61.8% retracements. Right now, we're below 2 of the 3 and possibly even 3 of the 3 based on the close on Friday. Again, you can pause your video player here, but this appears to be similar to what we talked about last week. Large cap, very large cap NASDAQ stocks appear to be trending again relative to the broader NASDAQ Composite Index. Here's the A to B move on the drop here. We're above the 38.2, the 50, and the 61.8, and we've remained above the 61.8 for several sessions now. NYSE Composite during Friday's session still holding above this low here. We'll learn something either way. This is a little bit concerning here. This is the NYSE advanced decline line. Has somewhat of a slowing momentum look. However, it is holding above this low that was made several sessions ago here, so we have a reference point here and a reference point here. If you've been watching these videos, you know there's been some weakness behind the major indices now for several months. This is the S&P 600 or small cap index. Have a high here and basically a consolidation pattern. The last high was made in June. This would be a step 3 here if we violate this area. Right now, it's just a consolidation box, but it looks a lot more vulnerable than, let's say, the S&P 500. Covered this chart and these concepts in detail last week. You want to rewatch last week's video. This is the look of the small cap index versus the broad NASDAQ composite during Friday's session around lunchtime. Really no change here relative to the weakening trend for small caps relative to the NASDAQ. Still in an area where it wouldn't be shocking if this ratio made a stand, but it still needs to prove it, and it's still in a downtrend. Similar concepts here, value versus growth. Value looks really, really good up here in May. And then we come back down here. We're not able to hold this trend line here. We're below it. We come back to it, kind of test this breakdown and fail. This A to B move here during Friday's session, we're below the 61.8, the 50, and the 38.2. Also in somewhat of an indecisive mode here, or an area around the 61.8 where it might make a stand, but it's really just not showing a whole lot yet. And when you look at this weakness here in the context of the longer term trend, which still unequivocally favors growth over value, have to be careful about how much capital we allocate to value until value is able to get back on track. It may do that, but it hasn't done it yet. Ultimately, when you're money managers, you're paid to manage risk. So charts like this have to be on our radar. This is small caps relative to long-term treasuries. It's very, very difficult to make the argument that this chart is not concerning. Small caps have not made a new closing high relative to stodgy and boring and defensive treasuries since March of this year. It is now July. The last thing this did was make a lower low, and it really is not even knocking on the door of reversing this intermediate term downtrend here. It's not a showstopper for anything in isolation. It just tells us to pay closer attention, something that we continue to do and something that we have been doing. Very, very similar situation here. Very, very difficult to brush this chart aside. This is SPY relative to TLT. The last intraday high was made back in May. And like the previous chart, it really doesn't look like it's about to break out in a bullish manner. Not a showstopper in isolation. Helps us with asset allocation, stocks relative to bonds. And also tells us not to assume anything relative to the major indices and their current bullish trends. This is SPY TLT. SPY IEF, intermediate term treasuries, does look a lot better. Recently made a new closing high here. So you can make an argument that this look here, at least in the short run, is offsetting this look here a little bit, but it doesn't erase this look. This is the chart in front of us here, and it is what it is. Having said all of that, as we've mentioned in these videos many, many times, we manage SPY in isolation. We don't use this chart to manage SPY. And SPY is, of course, the S&P 500, and the chart of the S&P 500 late in the session on Friday, July 30th, looks fine. The last thing it did was make a new high here. We have no significant new lows, and in terms of a trend change, we don't even have a step 1 at this point. When this chart was printed, the market was down roughly 27 points. At the close, it looked a little better. It was down roughly 24 points. So in terms of bearish probabilities, we need to see some damage on these charts. We may see that soon, but we just don't have it yet. Here are some areas to keep you on your toes, to keep you honest. This is JNK relative to TLT. This is waning momentum look for several months. This is March of this year. JNK IEF, also a waning momentum look now for several months, where my cursor is. Credit spreads have popped up a little bit, but still, they're very, very low and very, very tight and not particularly alarming. The look this week is here. Compare and contrast that to the alarming spike that we had during the COVID plunge. We can't ignore this. We can't ignore this, and we're not doing that. We're respecting it. But we can't ignore this either. This is the chart in front of us, and it still looks very, very healthy as of Friday, July 30th. The same thing can be said for growth stocks. Last thing it did was make a new high. We don't even have a significant break of any trend line or a lower low at this point. Very, very similar situation looking at VGT. Tech stocks in isolation. The last thing it did was make a new intraday high, a new closing high, no significant lower low, and no break of any significant trend line at this point. Plenty of reasons, plenty of hard data in front of us telling us that the market's tolerance for risk in this window here where my cursor's moving around, the risk-reward profile is unequivocally more favorable here than it is in the present day. But that doesn't change the fact that this is still a bullish trend. And if you manage risk for a living, all of this is good news, because there's plenty of ammunition to help us keep an open mind about a wide range of outcomes. And that applies to shorter-term time frames, intermediate-term time frames, and longer-term time frames. We unequivocally have some uncertainty in the market and some yellow flags, and we all know the best way to handle that is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.